Welcome students. So in the process of learning about the time value of money, now we will be talking about the some more concepts, and these some more concepts are, say for example, the next concept is the present value of a growing annuity, right? Present value of a growing annuity. So we all understand what the annuity is. Annuity is basically a fixed cash flow stream which keep on coming into a person or maybe to organization. It may be coming in or going out, both ways it is, but the amount has to remain same, and periodically it must be coming in or going out. When the cash flow stream remains the same and it periodically keeps on coming or going out, so that's called as an annuity. And now after talking about the annuity or understanding about the annuity and calculating the present and future value of an annuity, now we'll be talking about learning about calculating the present value of a growing annuity, right? So for learning about the present value of a growing annuity, first we will understand what the growing annuity is. So basically the growing annuity is a cash flow that grows at a constant rate for a specified period of time or for a specific period of time, or basically a cash flow that grows at a constant rate for the specified period of time is a growing annuity. The timeline for the growing annuity is shown below. So this is a timeline given to us, and in this case you see that what we have here is the number of years, that is 0, 1, 2, 3, 4 and n number of years, and A is basically the cash flow, right? So if there is no growth in the cash flow, it will be only A. But when there is a growth in the cash flow, growth in the annuity, A means the specified sum of the amount which is a constant amount, constant cash flow. So if it is not growing at all, it's remaining same, again it's called as a annuity, but annuity without growth. So it means it would be only A divided by maybe the discount rate. But in this case, because the annuity is growing, as it is written here, a cash flow that grows at a constant rate for a specified period of time, that is called as a growing annuity, right? So it means it's growing. First year's cash flow, what is there that we have got is is being multiplied by some growth rate. Second year also by the growth rate, and the third, fourth and number of years of the growth rate. So we are multiplying it by 1 plus g. So 1 plus g power 2, and it goes up to something like that 1 plus g power n over the n number of the years. So when any specific sum of money which keeps on coming to us for a unlimited period of time, that is called as a annuity, and then when it grows at a constant rate for the given period of time as well, it is called as the growing annuity. So in the growing annuity, if you want to calculate the present value of a growing annuity, we have to use this model, right? We have to use this model, and in this model, that's the present value of a growing annuity. So we can determine the present value of the growing annuity with the help of this. So again we are taking the cash flow A multiplied by 1 plus g into 1 minus 1 plus g divided by 1 plus r, because the r is not the means the rate of return is not same, but the cash flow is growing. So power n, and then divided by r minus g. So it means in this formula we have to be very careful that g has to be different from the r. Either it has to be more than the r or less than the r. Only then this model will work. If the r is equal to g or g is equal to r, or the growth rate is equal to the rate of return, so it means there is no impact upon the growth, and in that case you call it as, in that case the present value is simply the value equal to NA. So it means there has to be a difference between the r and g. The growth rate has to be different from the r, and in that case it can be more, it can be less. In that case the real say value of the present value of the growing annuity can be calculated. But if the r is going to be same with the g or vice versa, g is going to be same with the r, so in that case it's not going to give you any change, any impact, and in that case this model is not going to work. So it means if you want to understand what the growing annuity is, that when the cash flow increases, so it's certainly coming for a longer period of time. Annually it's coming to us for a specified period of time, but not at the same rate, but over the year it's growing, right? For example, when we talk about the annuity, normally the sum remains the same, that is, say for example 10,000, or we call it as 10,000, or we call it as 10,000, right? So this sum is same. But when this is growing, right, when this is growing, that you're seeing the 1 plus g, and this is also 1 plus g power 2, right, for the second year, and then it is 1 plus g for power 3 for the third year, and like that it keeps on going like 1 plus g for the subsequent years. So it means g is basically the growth rate. So this is year number 1, this is year 2, this is year 3, and when any sum which is A, which is being received by us over the period of time, keeps on growing at certain rate, then it's called as a growing annuity. And for calculating the present value of the growing annuity, we have to use this model. And now we can apply this model. You can see the application of this model. Another application of the present value of money, and especially the application of the growing annuity model. So in this case, for example, with the help of this particular case, this particular example, we can understand that how the present value of the growing annuity can be worked out, and how this model of calculating the present value of the annuity works. So just read the example very carefully. For example, suppose you have the right to harvest the teak plantation for the next 20 years, over which you expect 100,000 cubic feet of the teak per year. How much teak we are expecting? We are expecting 100 cubic feet of the teak per year, and number of period involved in this case is the 20 years, right? The current price per cubic feet of the teak is rupees 500, Indian rupees 500, what it is expected to increase at a rate of the 8% per year. Now, for example, when you talk about, when we are seeing, if we are given this information only, that teak plantation we are going to harvest for how many number of years? 20, right? And which is expected to be over the year, which is expected to be 1 lakh cubic feet. So it means if it is a 1 lakh cubic feet of the teak per year. So if we are given the information only about the number of years, that is 20, annual harvest, that's the 1000 cubic feet per year that is given to us, and the price per, you call it, cubic feet of the teak is also given to us, but the growth rate is not given to us. It means it's only simply an example of a annuity, that we are going to get the certain sum of the money at the end of every year, and that is for the 20 number of years, and total harvest is going to be 1 lakh cubic feet, and rate per cubic feet of the teak wood is the 500 rupees. So that's a one story or the one case, but that's the case of basically the case of annuity, not of the growing annuity. But in this case we are given here, but it is expected to increase at a rate of 8% per year. So this is basically the example of growing annuity. That's not going to stay same, that's not going to remain as the 1 lakh cubic feet and at the rate of the 500 per cubic feet. Means we are going to sell it, or we are going to get 500 rupees per cubic feet. So multiplied it by 1 lakh by 500. It's not the case, but it's growing at the rate of 8% also. So it's a case of the growing annuity, and when the annuity is growing, when it's a case of the growing annuity, so easily you can calculate the present value of the teak wood we are going to harvest from this field. And in this case, you have to get the value of A first of all. The value of A first of all is, if you see the model here, so first of all we have to calculate the value of A here, and if you calculate the value of A here, this is the value of A, right? This is the value of A, this is 500 into 1 lakh, and we have to multiply it by the growth rate. So it is going to be what? The formula says it is 1 plus G. So 1 plus G, basically it is the growth rate which is given to us here, that this annuity is going to increase at the rate of 8% per annum. So this is going to be 500 into 1 lakh multiplied by 1.08, because it is 1 plus G. So 1.08 into 1 minus 1 plus G power n. N is how much? 20 years, and divided by 1 plus R. What is R? R is basically the 15%. So it is given to us also. The discount rate is 15%. R means the discount rate is 15%. The present value of the teak that you can harvest from the teak forest can be determined as follows. It is clearly given to us. So what is important to us? The values important to us are the total period of 20 years, right? And annual harvest is going to be 1 lakh cubic feet. The price per cubic feet is rupees 500, and the growth rate is 8%, and the discount rate R is 15%. When we are given all these inputs, so we are multiplying this model A into 1 plus G. So A is 500 into 1 lakh into 1 plus G means 8%, so 1.08 into 1 minus 1.08 power 20 here, that is n, divided by 1 plus R, that is 1.15 for the 20 years period of time, and divided by R minus G. So it means, now you look at this, because R is different from the G here. R is 15% and G is 8%. So this model is going to work. But for example, if R is also 15%, G is also 15%, this model will not work, because ultimately there is no change is going to be, and the growing annuity model will not work. So finally, when you calculate this value here, so finally this value comes up as present value of the growing annuity would be how much? It would be 55 crores 17 lakh 36,683. This is going to be the total value, present value of the growing annuity, which we are going to get by harvesting the teak wood for a period of 20 years, which is going to grow at the rate of 8%, and per cubic feet of this teak is going to be sold in the market at 500 rupees, and the discount rate is 15%. So given all these kind of the inputs, if you apply this, means if you put all these inputs into this model for calculating the present value of a growing annuity, so you would get a value, you will get a figure, you will get a final amount, and this amount is 55 crores 17 lakhs 36,683 worth of the Indian rupees. The present value of this growing annuity is going to be there. More than 55 crores of the output is going to be there as a result of this growing annuity. So first of all, we have to understand what is an annuity. Annuity is basically a fixed sum of the cash flow, maybe coming in or going out over a period of time. But when it grows also over a period of time, it grows also, or there is an annual growth rate in this fixed sum, so it becomes the growing annuity. So for calculating the present value of the growing annuity, we have to use this model, and it's a very simple model but logical. And when we are given the inputs to test this model, so we gave all these inputs to this model, and finally we could get a value, that this value is basically the present value of a growing annuity, which works out as 55 crores 17 lakh 36,683 Indian rupees. So this way you can calculate the value of a growing annuity, and it's quite logical also that annuity sometimes, when we are going to receive a certain sum of money over a period of time, that doesn't remain stable, because time value of money changes. Over a period of time, when the time passes, the value of money goes down because of inflation or number of other factors. So same way the annuity also must grow. If the annuity is not growing, so finally because the value of money is going down and that annuity amount is not growing, so at one particular point of time, whatever the total inflow in the form of annuity is coming to us, the value of that would be very low. So in any case, for example, if any sum which is a fixed but also growing over a period of time, so that is called as a growing annuity, and for calculating the present value of that growing annuity, we can use this model. This is another interesting application of the time value of the money. Now before closing the discussion on the annuity, we will learn about something which is called as annuity due, or maybe the two structures. One is called as the ordinary annuity and one is called as the annuity due. When you call as the ordinary annuity, it means if you see the difference in these two structures, so the difference occurs here. Here the cash flow is occurring to us at the end of the first year, that is at the end of the year 1 and maybe the beginning of the year 2. But if you see this structure, here A, this cash flow is coming to us at the beginning of the period 1 or maybe year 1, and it means it is at the 0 level. It means in the beginning of the year 1 or period 1, we are getting the cash flows, right. So which annuity we are going to use normally? Which annuity we are going to use only? So you can easily understand annuity due value. Annuity due value is basically the ordinary annuity, right, or you call it as a deferred annuity also. Ordinary annuity we have seen in the past also, in some other previous classes also, that there is a ordinary or a deferred annuity, or there is a annuity due. So normally we discuss the case of the ordinary annuity or the deferred annuity, but in any case if you assume that the cash flow will not occur at the end of the period or at the end of the first year, but in the beginning of that first year, maybe at the 0 period, so in that case you have to call it as the annuity due, and for calculating the value of annuity due, you have to multiply it by the R, that is a rate of return. So ordinary annuity value into 1 plus R will become the annuity due, because here you are getting now the one cash flow extra. Here the cash flow was coming at the end of the first year, but here the cash flow is coming at the beginning of the first year. So it means this is annuity due and this is ordinary annuity. But normal course means whenever we go for discussion, whether paying any sum of money to someone or whether receiving it in the form of annuity, whether it is inflow or it is outflow, right? Normally, it is the ordinary annuity or the deferred annuity, and cash flow is treated to be occurring to anybody, maybe to individual or to organization at the end of the period or at the end of the year, first year, second year, third year, fourth year. So, normally we can say that cash flow is occurring either at the end of the first year or at the beginning of the second year. But in any case, for example, if it is given in the problem or in that case of evaluation that the cash flow will occur in the beginning of the year period, so that would be called as an annuity due, and for calculating the value of that annuity, maybe a simple annuity or a growing annuity, you have to multiply the ordinary or the deferred annuity by 1 plus R, right. You have to apply it by ordinary annuity value into 1 plus R, and be careful, this applies to both the present as well as the future values. So, point of caution is that when you talk about the annuity valuation, you normally talk about the in the form of the ordinary annuity or the deferred annuity. In that annuity, the cash flow occurs at the end of the period, first year, second year, third year, fourth year and nth year. But if in any case, if it is written that it is not going to be ordinary annuity, but the cash flow is going to occur in the beginning of the period, maybe it is inflow or outflow, it will become the annuity due, and for that purpose you have to multiply the ordinary annuity value with the 1 plus R. So, this point is very carefully to be taken into account, otherwise the results will significantly differ and ultimate purpose of calculating the final value of the annuity, maybe present or future value, may not be attained. So, you have to be very careful which annuity we are going to talk about and how to evaluate it, whether it is an ordinary annuity or it is an annuity due, and accordingly you calculate the present or future value of that annuity. Now, we talk about the perpetuity. After the annuity, we talk about something which is called as the perpetuity. So, what is the perpetuity? So, perpetuity is another important consideration in the time value of money. First, you try to understand what the perpetuity is. Perpetuity is an annuity. Perpetuity is an annuity for infinite duration. Perpetuity is an annuity for a infinite duration. Hence, the present value of the perpetuity may be expressed as follows. It means the basic difference between the annuity and perpetuity is, annuity is still maybe for a longer period of time, but the time period ends somewhere. It is for maybe for a given period of time, 20 years, 30 years, 25 years or 15 years, right. A perpetuity is an annuity of infinite duration. So, it means annuity has the finite duration or a limited duration which can be foreseen, which can be calculated, and which can be a longer duration but not unlimited. But any sum of the money which is going to come to us, fixed sum of money, which either going to come to us or we are going to pay to somebody for an infinite period of time, sum is going to remain the same. It can be growing also, but normally we assume here that it is an annuity because sum to be received or to be paid is going to remain the same. So, that is going to be called as annuity. So, it is not 20 years or 15 years. It is going to be for the infinite period of time, and any cash flow, fixed amount of the cash flow, when it is going to be inflow or outflow for an infinite period of time, that would be called as the perpetuity. And for calculating the present value of the perpetuity, you will use this very simple model where A is basically the cash flow, that annuity which is going to occur to us, and R is basically the discount rate or the interest rate which we are going to discount this value at, right. We are going to discount this value at. So, we are assuming here that present value of the perpetuity is 100,000 or 1 lakh rupees, and the interest rate R is basically 10%, right. The interest rate is 10%. So, what will be the present value of this perpetuity? So, you are dividing this 1 lakh rupees by 10% and finally you are getting this 10,000 rupees, and it is intuitively very logical. It is very logical also. Simply you can understand that if we are going to get a certain sum of money, maybe you call it as the rate of return, you call it as the interest rate, you call it as whatever it is, return on investment we call it as sometimes, though there is a difference between the interest rate and return on investment, but for the sake of understanding, you can say the return coming to us, the interest coming to us on any particular sum on the cash flow is, that is the 10%. So simply you can understand that the present value of the perpetuity, if you want to call it the present value of the perpetuity of rupees 1 lakh, that we have got this 1 lakh rupees, we have deposited somewhere, we have lent it to somewhere, and he is going to pay us every year. He is going to pay us at the rate of 10%, and that is for the endless number of years. So that would be quite logical, because this is called as perpetuity because of certain factors. One factor is because it is for the unlimited period of time, for the infinite period of time. One, cash flow is going to remain the fixed because the rate of interest is fixed. So total amount which is deposited is 1 lakh rupees, and the interest rate on that is the 10%. So finally, when you are dividing the 1 lakh rupees by the 10%, it means every year 10,000 is going to come back to us, and for the unlimited number of years, until and unless there is any reduction, any kind of the reduction in this value of this sum, or maybe any kind of the changes in this interest rate. It may be possible that the value of this 10,000 will keep on declining over the number of years. 10,000 in the present year, in the current year, will not be same the next year, or maybe the next to next year, or maybe next to next to next year, right? The value will come down, but in total, you call it in the physical form, this 10,000 rupees will come to us, will keep on coming to us until and unless there is any change in the basic sum of this 1 lakh rupees and the interest rate or the interest rate. So it's a perpetuity, and for calculating the present value of the perpetuity, you are going to divide that perpetuity, that the sum of the money which is going to be the source of that cash flow, by the interest rate, that is R, and finally certain sum is going to come to us, that is called as 10,000 rupees, and this 10,000 rupees is the perpetuity, which, because we are going to receive it, or maybe we are going to pay it for the unlimited period of time, this annuity which is 10,000 rupees, we are going to receive or pay it for the unlimited period of time. So it becomes a perpetuity. So any cash flow, right, a perpetuity is what? An annuity of the infinite duration. Any cash flow being received or paid for an infinite duration is called as the perpetuity. So on a certain sum of money, for example, you have made this investment either in some fund or in some project, or anywhere you have invested this 1 lakh rupees, right? And you are promised that every year you will get the return of this 10% rupees at the rate of 10%. That's the rate of interest. So it means perpetuity value would be, that is 10,000 rupees, means the present value of the perpetuity would be 10,000 rupees, because out of this investment of 1 lakh rupees, every year you will keep on getting this 10,000 rupees, and that will be for the infinite number of years. That's why it is called as perpetuity. And the last thing we are going to talk about is the compounding period, the magic of compounding and the compounding periods. We have the different kind of the compounding periods, and when you calculate the compound interest as compared to the simple interest on any investments or borrowings, the total value of that money, or the total amount of that money, if it is an investment, grows faster, and if it is a borrowing, we have to pay the little more as compared to the simple rate of interest to the source from where we have borrowed the money. So when we make investment and our investment grows at a very faster rate, we call it as it is happening because of the compounding, and the magic of compounding is very, you call it as the value adding, interesting and useful, right? This compounding is two-way traffic. This is not a simple, you call it as the one-way traffic only on the deposits. It's on the borrowings also. And these days in the Indian banking system, when we invest any money in the banks, and if it is on the compound rate of interest, so the compounding has to be on the daily basis, and this compounding of daily basis happens on both the situations. It happens in case of the deposits also, it happens in case of the borrowings also. So both in case of deposits, in case of the borrowings, the compounding plays a role, and compounding means not receiving or paying the simple rate of interest, but the compound rate of interest. So when you have to calculate the compound rate of interest, so for calculating the future value of any sum, whether it is a deposit or it's a borrowing, so you have to use this model, and for calculating this model or using this model, you have to take the present value of that investment, multiply it by 1 plus R divided by M, and you have to give the power of M into N. M into N is basically the number of compounding periods. N is the number of compounding periods, how many times you want to compound how many times you want to compound your investments or borrowings. So you can easily understand the notations of this model. R is basically what? Nominal annual interest rate, right? R is basically nominal annual interest rate if it is a simple interest rate. If you make your investment on the simple interest rate, then R is a simple interest rate. If you borrow any money at the simple interest rate, R is a simple interest rate. M is basically number of times compounding is done in a year, right? Number of times the compounding is done in a year, that is called as the M. And N is the number of years over which the compounding is done. N is the number of years for which the compounding is done. So, one is the times and another is the years. So, this is basically the times and N is basically the years. So, in this case, when you want to calculate the compound value, say compound value of any investment, you call it as the future value of any investment or future value of any borrowing on the basis of the compound interest. You have to use this formula, you have to use this model, and for calculating this compounding process, understanding this compounding process, when you are using it, when you are not compounding it, you are using the simple rate of interest, that is R. But when you are compounding it, so you are compounding it maybe once in a year, every 6 months, or quarterly, or maybe monthly, or maybe you call it as the fortnightly or daily. These days, normally in the Indian banking system, we go for compounding for on everyday basis, daily compounding basis, and that compounding applies to both borrowings as well as the lending. So, your investment also grows at a faster pace, your lending, your borrowings also go on a faster pace. So, both ways we have to understand that the impact of compounding is always there both upon the borrowings as well as on the investments. So, if you are going to make investment and that investment is going to give you the compound rate, you can easily calculate it, or you can find out that, for example, you are going to make investment in any project and you are not drawing any interest out of it or any income out of it, and simply you want to know at the end of the year that I invested a certain sum of money, how much it has become because of the project activities at the end of the year. So, you can easily find out that value, and for that purpose you can find out the compound interest rate. Or if you are not into any kind of the investment, maybe the project activity or anything, you are simply giving your money to the bank or any other financial institution, or maybe any other investment you have made in the bonds or into the stocks. So, if you want to calculate the compound interest, you can easily calculate that interest, and finally you can get to know at the compound interest how much your money has grown. Had it been a simple interest, what was the growth rate of your investment, and now if it is a compound interest rate, at what rate your investment is growing. So, for example, we take the values here. The total investment we are going to make is, that is the 5,000 rupees, and we are going to calculate the future value of this 5,000 rupees on the compounding basis. So, present value is 5,000 rupees, rate of interest R is how much? That is 12%, and compounding is being done how many times? 4 times in a year. And how many years are there for this investment? They are 6 years. So, in this case, the total, if you put all these values into this model, you will find out the present value for which the future value is going to be calculated is 5,000 multiplied by 1 plus 0.12, that is the 12% rate of interest, and it has to be divided by M, that is a compounding, times, and power is 4 into 6. 4 is the compounding time, 6 is the number of years. So, finally, you can understand over a period of 6 years at the rate of 12% compound interest, where the compounding is being done for the 4 times in a year, your 5,000 rupees will become 10,164 rupees. It will be more than double of your amount just in a period of the 6 years. But had it been a simple rate of interest, then your money would not have become doubled or more than double in the period of 6 years. It would have been certainly less than this amount. So, this is the magic of compounding. This is the interest of the compounding, and when you calculate the compound interest, the investment grows at a very faster rate. It applies on both borrowing as well as the investing, and if you borrow the money and if it is on the compound rate of interest, you have to pay the higher value as compared to the borrowings, and if it is the investment, you are getting the compound rate of interest on that investment. Certainly, your investment will grow at a very faster rate. So, multiple periods compounding, shorter compounding periods means, and as this compounding period goes down from the 4 times in a year to every day 365 times in a year, certainly the growth rate would be spectacular. It would be growing at a very faster pace. So, we have seen in this case that when you are investing 5,000 rupees at the rate of 12%, and it is a compound rate of interest. Compounding is being done 4 times in a year. Time period involved is 6 years. So, within a 6 years period of time, this 5,000 rupees are going to become 10,164 rupees. So, this is basically the effect of compounding, magic of compounding, and because of this effect or magic of compounding, your investments also grow at a faster pace, your borrowings also grow at a faster pace. So, in both ways, we have to be very careful which interest we are going to receive or pay, and how much money we are going to receive and how much money we are going to pay as a result of compounding. And the last part of discussion for this today's discussion in this class, and being the part of the last part of the time value of money calculation, will be calculating or will be learning about the effective versus the nominal interest rates. Effective versus nominal interest rates. So, you must have heard many times about that when you give your investment to any company in the form of public deposits or maybe in any form you invest anywhere. So, they advertise like that, for example, the rate of interest is 6%, but if you want to talk about the yield is, for example, say 6.9%. So, what do we mean by the 6% and what do we mean by this yield of the 6.9%? So, when you talk about this 6%, this is a simple interest, right? 6% is a simple rate of interest. But when somebody is saying that the yield available is 6.9%, it means he is referring to the compound interest. So, you have to understand the difference between the simple interest and the yield or the compound interest. So, when people advertise that if you give your investment to us, we will return you after a certain period of time at the rate of 6%, where the yield on that investment would not be 6%, what 6.9%. It means 6% he or she is talking about the simple rate of interest, and 6.9% is basically the compound rate of interest, which is called as the yield, right. So, the model for calculating the effective versus nominal interest rate. So, nominal interest rate is basically the simple interest rate, right. This is the simple interest rate, and this is the effective, means this is a compound interest rate. These are the two interest rates. So, are we going to get on our investment simple rate of interest or the compound rate, means interest at the compound rate? So, the model is this: you can calculate the effective as well as the nominal interest rate with the help of this particular model, where the model is R is equal to 1 plus K divided by M power M minus 1. So, R is basically effective interest rate, which is as a result of compounding it will be more than the simple rate of interest. K is basically the nominal rate of interest. In the previous case we saw here that this is basically R. In this model, in the compounding period, this was R, and in this case we are saying it is nominal rate of interest is a K, and frequency of M is basically the frequency of compounding per year. M is basically the frequency of compounding per year. So, if you take to understand this case of the effective versus the nominal rate of interest, we take an example where the simple rate of interest is 8%, right. Simple rate of interest is 8%. Compounding is M 4 times a year, and R is basically, we have to calculate the R. So, in this case, by applying this formula, this model, for calculating the value of R, that is basically you call it as the effective rate of interest. So, we are applying 1 plus 0.08 divided by 4, power 4, that is a compounding period, minus 1. So, finally it becomes, means you have to add something into this, and finally this amount becomes 0.0824, and in the percentage terms this effective rate of interest becomes 8.24. So, against the simple rate of interest of 8%, compound rate of interest becomes 8.24, and this is happening because of the effect of compounding, magic of compounding. So, 8.24 is basically the compound rate of interest when you are compounding it quarterly 4 times in a year, and 8 is only the simple rate of interest. So, when you want to understand the real difference between the nominal and effective rate of interest, you can understand here that, for example, nominal rate of interest is 8% and 12%, or maybe initially talk about this is a nominal percentage rate which is 8%, right. If you are compounding it annually one time in a year, no effect of compounding would be there, so it is remaining as a 8%. But when you are you are compounding it twice a year, it becomes 8.16. When you are going for quarterly compounding, it is becoming 8.24, and when you are going for monthly compounding, it is becoming 8.30, and if you compound it every day on the daily compounding, the effect would be very high, So, it may be possible that 8% of the simple interest becomes 9% as the compound interest. So, the yield would be 9% and the simple rate of interest would be 8%. Similarly, if you pick up this, for example, the nominal rate of interest is 12%. Annual compounding, if you do, it remains as the 12% same. But if you are doing half yearly compounding, it is becoming 12 is becoming 12.36. If you are making it quarterly compounding, 12% is becoming 12.55%, and if you are making monthly compounding, 12% is becoming 12.68%, and if you are making the daily compounding, certainly it would be significantly higher. So, 12% may become 13% also, or 13.5% also. So, effective versus nominal rate of interest, the simple difference is the nominal rate of interest is basically the simple rate of interest and effective is basically the compound rate of interest. With the help of this model, you can calculate the effective rate of interest, which is basically a compound rate of interest, and compound rate means the value of compound rate would be going up the moment the compounding period increases. If the compounding period is annual, no change. If it is half yearly, yes, change. If it is quarterly, little more, but if it is monthly compounding, it is effectively higher, and if it is daily compounding, as it is happening these days in the banks, when we are investing money or borrowing money in the fixed deposits, when we are investing money, we are borrowing money from the banks. So, the compounding of that borrowing or investing is on the daily basis. So, we expect a better growth of our deposits, and same growth happens or applies on the borrowings also. So, do not get illusioned. Do not get maybe confused that what is the difference between the effective rate of interest and the nominal rate of interest. Simple thing is, nominal rate of interest you can easily understand, it is a simple rate of interest, and effective is basically the compound rate of interest. When you get the interest on interest, it is basically the effective, or it is because of the effect of compounding or the magic of compounding, and the simple and the compound rate of interest, wherever it is applicable, we can understand in the form of nominal rate or in the form of the effective rate. Sometimes we call it as the simple rate and yield available, or the interest rate and the yield available on that investment. So, the interest rate is the simple interest, yield is basically the compound interest, and this yield more or less largely depends upon the frequency of the compounding period. More means higher is the compounding period. So, higher would be the growth of the funds, better would be the growth of the funds, your funds would grow at a faster pace. So, this was the last application of the time value of money, and with this process, understanding all these applications of the time value of money, you must have understood by now that what role it plays, the time value of money plays, and how effectively it helps us to calculate the present or future value of any investment or any borrowings or any sum of money, why it is important, how inflation plays a role, what other important factors are important for us, and for calculating the growth or maybe reduction in the value of any investment or any borrowing or any lending, time value of money is going to play a very, very critical role, very, very effective role. And for that process, for that purpose, understanding this concept was very much required. That is why we discussed at length, and before becoming an entrepreneur, making any investment in any venture and learning about the nitty-gritties of the overall project management and project finance, understanding of the present value of money was very important, and that is what we discussed at length. So, for the moment I will stop here, and in the next class we will meet with the next concept, very important interesting concept, and that would be really means helping us how to evaluate our investment while made in any project or in any venture, and that would be called as the investment criteria, right, evaluating the investment, and that would be called as the investment criteria. So, till the time we start talking about the investment criteria, I will stop here and we will meet in the next class. Till then, thank you very much.